Hello, everyone, and welcome to today's webinar, Dishing Out Tax Relief, One Big Beautiful Bill Act Strategies for Restaurant Owners and Operators, sponsored by GBQ Partners, LLC. Now, I'd like to introduce GBQ's partner, Tax and Advisory, Kaz Uniland, to start today's webinar.
All right. Thank you, Demetra. Thanks, everybody, for joining us today. As Demetra said, my name is Kaz Unil, and I'm a partner in our tax practice here at GBQ, and I co-lead our restaurant practice. So appreciate everybody making some time here today to join us. As we get started here, I just want to introduce my two other colleagues who are going to be joining us in the presentation today. Tax partner Ryan Kilpatrick and John Powell, who's a senior manager on our cost segregation group. And with those two gentlemen, we're going to cover a number of agenda items here today. The background of the One Big Beautiful Bill Act we'll talk about generally, just to give a little bit of flavor on kind of what led to where we're at here today. We're going to talk about some provisions impacting businesses. We're going to take a deep dive in fixed assets and depreciation. That's what John's going to cover for us here today. Spend a little bit extra time on that just because that's something that really impacts all of our restaurant clients on some level, one way or another, and there's some good stuff in there that we want everybody to be aware of. Outside of that, Ryan's going to cover provisions impacting individual taxpayers, some other miscellaneous provisions that got sprinkled in there, from the campaign trail, and then some sunsetting provisions too that weren't covered by this bill that will impact the restaurant industry that we want to make sure that we cover today. And then hopefully we have some time at the end for questions. As Demetra mentioned, if we don't, we'll definitely get back with everybody on those and make sure that we get everything answered. First thing we need to take care of is a polling question here. So if everybody would, please, we should have it popping up here on your end to answer one of these questions here. How familiar are you with the One Big Beautiful Bill? And again, this is for those of you getting CP. We just want to make sure that we knock one of these out of the way. There'll be a couple more of these throughout the presentation just to get things squared away for CP purposes. Give it another second or two here. All right, great, thank you. So just a little bit of background. So this is something that we've been waiting for since the transition in presidency. This bill was signed into effect on July 4th, so it was Christmas in July for us as tax practitioners here. But many of these provisions relate to things that were going to expire at the end of this year. So we've kind of been in limbo on some level, just kind of waiting for something. We knew there was going to be a tax package put out here just to address those things that expire at the end of this year. Made it a little bit difficult to plan. We had some ideas on what things were coming. We just didn't know essentially how it would all shake out. But most of these things extend a lot of what President Trump put into place with the 2017 Tax Cuts and Jobs Act. So a lot of those provisions were extended. There's some new twists on a handful of them, but good stuff overall. There was also some stuff related to promises made on the campaign trail. Ryan's going to largely cover those. No tax on tips, no tax on overtime. And then some of the other things in there really aren't restaurant related, but reduce some of the green initiatives. And I think some of those things might have been revenue raisers to offset some of the cost of this package. But beyond that, we're not going to get really into too many of those things as they won't have too much impact to those in the restaurant industry. As far as provisions impacting businesses, the handful of items I'm going to cover are Section 199A, Qualified Business Income Deduction, 163J, which this is the interest expense limitation that many of our clients have been bumping into the last couple of years. So we'll talk about that one. There's business meal deductibility, something that was going to expire this year that they extended. And then one item that just never seems to leave the news on the tax front is the employee retention credit. One little wrinkle related to that actually has had an impact on a handful of our clients related to those filing for those claims. As it relates to Section 199A, this is the Qualified Business Income Deduction. So this is something that's been around since 2018. This was part of that Tax Jobs and Cuts Act that President Trump initially put into place during his first term. And so this was effective 2018. It was set to expire at the end of this year. The One Big Beautiful Bill Act now makes this deduction permanent, so that's good news. Gives us some certainty, allows us to plan better with it. And just as a refresher, this is a deduction that all restaurant owners should have gotten since that was enacted in 2018, and it's a 20% deduction of qualified business income. So at a super high level, if you have $1 million of taxable income under this provision, you're entitled to a 20% deduction or a $200,000 deduction. And whereas at that point you would only pay tax on 800,000, so it effectively reduced your rate by 20%. But it was a big deal to our restaurant clients and others that qualified for it. And there's a little note there that you're subject to W-2 wages and capital investment limits. In the restaurant world, usually there's plenty of wages that take that deduction against. We never really bumped into that. And no issues with that in the past, but this is one that is now made permanent. So good news on that front. In addition to that, one that had been an issue for a lot of our clients the last 2 years is this 163J limitation on business interest expense. So this was also something that was new in part of the Tax Cuts and Jobs Act that President Trump enacted in 2018. And so this is the one where it limits your business interest deduction to 30% of your adjusted taxable income. I've got a really high level example on this, but this is one that, from 2022 forward, a lot of our restaurant clients and others were bumping against this limitation where it was really reducing interest expense deductions for a lot of our clients. And kind of the profile there has been we've had a lot of clients that have done acquisitions, have taken on debt, or just by growth, organic growth, new locations, spending money, CapEx money, and taking on debt related to that. You kind of get a perfect storm with interest rates rising, the change in this rule, or where this rule was based on EBIT in 2022, so based on your earnings before interest and taxes. We had a lot of clients that have been bumping into this and, really not eliminating, but severely impacting their interest expense deduction. And so this One Big Beautiful Bill Act actually addressed that, and it changed the definition to really relax that limitation and open up the ability to deduct more interest expense. So under the One Big Beautiful Bill Act, the adjusted taxable income definition is now changed from EBIT to EBITDA. And so it's actually going to be a real big benefit to a lot of our clients. In this example here, this is a super high level simplified example, but we thought it was worth at least spending a minute or two just to get people to think about it. So this shows kind of in two different scenarios here. One, kind of what your interest expense deduction would have been under the Tax Cuts and Jobs Act, the previous regime. And then two here, secondly, under the One Big Beautiful Bill Act. And so you can kind of see in the two columns, one's based on EBIT and one's based on EBITDA. So in that example here, you can see that under the old rules, the taxpayer in this case that had 2.5 million of interest expense would have been limited to only being able to deduct $2,280,000 of interest. However, under the new rules here for 2025, they get to fully deduct that $2.5 million interest expense. And so, that's going to be a really big positive impact for all of our clients across the board that have kind of got caught up in this one here. So good news on that front. And at the end of the day, if you are limited by this deduction, that interest expense isn't permanently lost or doesn't go away forever. It's actually suspended and carried forward, and so just pushed into future years. But hopefully with these new relaxed rules, not too many people are going to run into that as an issue. Beyond that, there was one other provision in there related to business meals, and actually specifically the restaurant industry. This was one that was supposed to go away at the end of this year, and that's the 100% deduction for meals provided to employees by businesses that also sell food. Obviously restaurants, but includes takeout, dine-in, and delivery. So those are just for your employee provided meals. That was set to go back to 50%, I believe. But that's going to be fully deductible, 100% deduction through January 1st, 2027. any other employer provided meals are still subject to the 50% limitation. So that's one other little thing that was kind of slipped in there that we wanted to point out. And then finally, the employee retention tax credit. I know there's a number of our clients that are still waiting on refunds. That's starting to break loose here a little bit. Since the beginning of the year, we've seen more clients get refunds. The IRS has said they're actually starting to process them. It's been a very, very slow process, but we are seeing refunds come through. One of the things that was kind of buried in this bill that you may not think is a big deal or might not impact a lot of clients was that the employee retention credit payments are cut off for any claims related to Q3 and Q4 of 2021 filed after January 31st, 2024. So that was something that was actually in a previous bill that didn't get passed. They kept that in here again. That's probably more of a revenue raiser, but we had a handful of clients who actually qualified for employee retention credits for Q1 and Q2 of 2021 that actually filed after that January 31st date. And so we were worried that they may get cut off from that, but they just limited it to Q3 and Q4 of 2021. So something in there that we thought was important to point out as it relates to employee retention credits. At this point, we have our second polling question. So if you could, we're going to come up on the screen here. Does the passage of the One Big Beautiful Bill provide any additional certainty to your business in making decisions? Let's see where all that lands. Okay. All right. Good deal. At this point, I'm going to hand things off to John Powell. John is going to dig into depreciation and other items here tied into fixed assets that are part of this bill. That is definitely some good news and important stuff here to our restaurant clients. So, John, I'm going to hand it over to you at this point. Thank you.
Yeah. Thanks, Kaz. So I wanted to start off by talking about bonus depreciation in particular with the TCJA and maybe some other TCJA provisions, so that we can kind of show a side by side of how they look versus the changes that we're seeing under the One Big Beautiful Bill Act. So the TCJA expanded and enhanced bonus depreciation. We got 100% bonus from for assets that were acquired and placed into service after 9/28 of 2017 through December 31st of 2022, and then we saw a 20% phase down kind of year over year. So as you can kind of see from this, we were kind of as we're doing planning these past 7 months for 2025, we were looking at this kind of 40% rate. And then, as you recall, bonus was expanded to include both new and used property, which I want to talk about that a little bit as well, because that will have some bearing on what we're going to look at under the One Big Beautiful Bill Act. So new property, we might think is kind of fairly a basic term, but it's maybe not. So the tax legislation looks at new property as original use, so something that's constructed by the taxpayer. And then used property is subject to certain requirements. So when we're talking about, say, components or equipment, we would look at when a written binding contract was in place to purchase that component or piece of equipment. When it comes to self-constructed property, we had to get a definition, and that definition really led to some other guidance. And so self-constructed property was defined as property that was either built by the taxpayer or um, by another person that was hired by the taxpayer under a written binding contract. So written binding contracts um, are subject to state laws, um, but in general, um, you can kind of think of them as when does a contract become enforceable? And so um, what we had to look at under TCJA was especially for new construction or build outs, which I know pretty frequent in the restaurant industry, um, would be when is the contract entered into with the contractor? And then we also need to look at when a significant physical amount of construction has occurred. And so there were two tests that we got in our regulations in the last round of regulations surrounding that. Um, and the first one was um, if you were building if you were building a new building, um, when the footings were put into place on the building. The second test was a 10% test. So it looked at the total cost of the property. Um, it took out some preliminary activities, such as securing financing or looking for a location, that sort of thing. And then once you exceeded 10% of the total cost of the property, or that was the date at which the property was considered acquired. Um, so what we have is we had this law that um, bifurcated a tax year, and then so we had to look at an acquired date and a placed in service date. So as we look at the One Big Beautiful Bill Act, we have the same thing that's kind of going on all over again. So for property that's acquired and placed into service after January 19th of 2025, um, we will have 100% bonus, and that was a permanent change. So we're not going to see this phase out. So that's going to allow for um, better planning of our capital resources kind of into the future and how we expand and how we think about whether we're going to build a new location or we're going to acquire a new location. Um, Again, still, it applies to both new and used property. Um, we got rid of the phase down limits that were part of the TCJA. Um, It did, interestingly enough, strike one code section, which applied to property that was acquired prior to 9/28 of 2017 and placed into service after 9/27 of 2017. So it looks like there might be some wiggle room. It remains to be seen. Um, on what the regulations, how the regulations change. So if you were in the process of, constructing a new restaurant or having a new build out done where construction began prior to January 19th of 2025, but you're not expecting to place it into service until say, June of 2025, it's not going to be it's not 100% certain how this provision for 100% bonus is gonna turn out. Uh, our thoughts, for what it's worth, is that um, the regulations likely aren't going to change much in the way of mechanics. So um, we saw 100% bonus back in 2011, where we had very similar regulations. And again, seeing that those regulations kind of have the same structure for the 2017 tax law changes. We kind of expect that there's going to be a group that had construction going on in late 24, and then placing stuff into service in 25, where they're going to get that 40% bonus rate. I should also note, and I know it's not on this slide, but there is an election that can be made, and so that kind of similar again to past tax law changes related to bonus depreciation, where in the first taxable year, after January 19th of 2025, taxpayer can elect to utilize a 40% bonus rate structure versus a 100% bonus. So it may or may not apply, but sometimes we like to have kind of manage our income in certain ways. The other thing that I wanted to kind of discuss is something related to what Kaz talked about with 163J and the business interest expense limitation. So one of the things that we saw in the past there was that after we weren't allowed to add back that depreciation, we saw a lot of clients that were running into this business interest expense limitation, and may or may not have made the election under 163J to not limit business interest expense. So what would happen if you made that election, which is a permanent election, you had a change in use that occurred. So any non-residential real property and any qualified improvement property that was on the books then changed to an ADS method, and you're required to depreciate any new non-residential real property and any qualified improvement property using ADS, which meant that you got a 40-year life for non-residential real property versus 39 years, and you got a 20-year life for qualified improvement property versus the 15-year. But what it also did is that if you made that election, you were also precluded from claiming bonus depreciation on qualified improvement property because you were required to depreciate it using the ADS method. So again, that's another one where there's this wrinkle where we're not sure what the guidance is going to look like there yet. If they're going to provide the ability to amend a return to fix that on a go forward, or if they're going to provide some other changes on that. But that is something that kind of a wrinkle of this 100% bonus and how we look at business interest on a go forward. We do expect that if you hadn't made that election, that probably is something now that our clients that maybe are looking at that probably will slow down a little bit. We wouldn't expect as many clients to make that election anymore because they're just not going to be interest expense limited there. All right. Moving on, the One Big Beautiful Bill also created a new class of property. So this won't apply to a lot of the restaurants, but we do know that we have a handful of clients here that also have some manufacturing portion to their business. And so this is something that we wanted to discuss and bring up because this is a new provision. We weren't sure that this was going to necessarily make it through to the final version, but it did. So that's pretty great. it's very similar to what we saw in 2015 when qualified improvement property came out. Um, and we are expecting some regulations on this probably in the next, you know, 8 to 9 months, so that once this actually does become eligible to be claimed on a tax return, that we have that guidance in place. Um, so 168N was added to the code section, and it created this class of property called qualified production property. So qualified production property, or QPP, is any portion of a non-residential real property used as an integral part of a qualified production activity. Um, that activity must occur within the United States, um, and the original use must commence with the taxpayer. So again, this is very similar to kind of the other qualified properties that we've seen over the years, whether it be qualified leasehold improvements or QIP, where this isn't something that you can purchase. This is something that you would have to construct. And then QPP, you would have construction must begin after January 19th of 2025, and before January 1st of 2029, and then be placed into service prior to January 1st of 2031. This election, this property is an elective provision. So where bonus depreciation is not elective. So if you have qualified property for bonus depreciation purposes, you must claim bonus depreciation unless you specifically elect out. This is something where you would elect to claim this property. And once you do that, this portion of the property would be eligible for that 100% bonus depreciation that we talked about under the One Big Beautiful Bill. So what is a qualified production activity? So that was defined in the bill. As manufacturing, production, or refining of a qualified product, and substantial transformation must occur. Production shall not include activities other than agricultural production and chemical production. So this one kind of seems a little bit of an odd statement in the bill, but I think the kind of some of the examples that we've seen and heard where we talk about what substantial transformation is would be kind of similar to the old D-pad rules where let's say you have a bunch of wood pulp and then you're turning that into paper. Obviously, there is a substantial transformation there, and so that type of activity would be qualified for this. A qualified product means any tangible personal property if such property is not a food or beverage prepared in the same building as a retail establishment in which it's sold. So again, for our subset that kind of has that production activity, if we have a bunch of, say, flour, and we're turning that into, pizza dough or bread dough, and we have bread afterwards, I think we have a substantial transformation. And as long as that is not being done in the same building that as a retail, there is a potential here to claim to be able to make this election. One point to note is that there's a 10-year period where if the property ceases to be qualified production property, then you would be subject to 1245 recapture, which is at ordinary tax rates. And so this is something that we would want to really kind of investigate as far as is the election useful or not. And then the act does talk about some regulations that will be issued regarding what constitutes substantial transformation, and talking about as well uh, kind of who that subset is, lessors versus lessees, et cetera. So we expect that stuff again to be coming out here in the next year or so. Next, I want to talk about tangible property regulations. And kind of at first blush, you might think that a lot of this stuff might not make sense anymore. One of the things that we really have to consider, though, is conformity issues, depending on the states that you're required to file in. Um, it might make sense to really consider some of these items, and not just kind of fall back on 100% bonus. So most of the tangible property, well, all the tangible property regs remain unchanged. And so I just wanted to run through those again. So we have de minimis expensing. So taxpayers without applicable financial statements would be eligible for a de minimis of up to $2,500, where they wouldn't have to capitalize any expenditures under that amount. If you have applicable financial statements, so I would think of that more as like audited financial statements. The safe harbor is $5,000. These expenses need to be expensed on both the book side and the tax side. You have to have a written capitalization policy in place as of the beginning of the year, that states that. And these expenses need to be supported on an invoice by invoice and unit of property by unit of property measure. We also have the routine repairs and maintenance safe harbor. So I know that this one has been a big one for a lot of our restaurant group, talking about looking at kind of these repairs, especially when we have like franchisees that maybe have just a couple of stores that have certain requirements that they need to do, or just from traffic, we need to kind of constantly kind of fix things up. And so the rule here is really maybe a little bit intensive for a lot of people, but looking at if the expenditure is related to an improvement to the property, and the regulations give out, there's three different types of improvements, which are a betterment, a restoration, or an adaptation to a newer, different business use. And then if it is not one of those items, then we would look at it as an expense for routine repairs and maintenance. This is done on a unit of property by unit of property basis as well. So a great example of this might be, the one that we see a lot. You have a rooftop unit, and the blower motor in the rooftop unit needs to get replaced. And so what do we do with that expense? Because sometimes that expense can be, $5,000-6,000 a pop, sometimes even more. And so we would look at that. If we determine it's not an improvement, then we would expense that. The nice thing about the tangible property regs here, particularly on these two, on the de minimis and routine repairs and maintenance, is that these would not be subject to recapture in the event of a disposition, because it actually kind of takes these expenses off of your balance sheet. The third tangible property reg that we should still be looking at here would be this remodel, refresh, safe harbor method of accounting. So this is related to particularly, I think the general kind of idea here would be, if you have a franchise where you're kind of required to have a certain image, and you have these kind of image upgrades, or you're selling tangible goods, which food would qualify under this, where you're doing things to the store, to either make it more efficient or to give it a new look. Then there's the safe harbor where you can essentially deduct 75% of those expenses, and then you capitalize the remaining 25%. Um, and so this one would still kind of provide a lot of value, especially when if we don't have that qualified production property. This one would provide a lot of value to our purely restaurant or store owners, that retail side of things. Um, if you recall, kind of we lost qualified restaurant property as part of the Tax Cuts and Jobs Act, where all of our property was 15-year property, and so this really kind of helps us, kind of one way we can kind of claw back some of that benefit there. Um, So yeah, again, I think that this is still going to be in play, and something that we still want to plan for. Um, Again, so when you have this property that's maybe not bonus eligible, so um, things like the facade updates or things like that that wouldn't necessarily be bonus eligible as part of qualified property in under 168K. These are things that methods we could look at to potentially accelerate those deductions. Again, there's no state conformity issues with tangible property regs where you might run into those with either 179 or bonus. And this isn't subject to recapture in the way that bonus is subject to recapture. And then finally, we did want to talk a little bit about the R&D tax credit, Section 174 expenses. So again, maybe this doesn't apply to everybody, but we do have a subset of our client base that we see that is able to claim this R&D tax credit. So under the TCJA, we saw that Section 174 expenses were required to be capitalized and amortized ratably over a 5-year period. When prior to TCJA, they had been deducted currently. So prior to TCJA, right, we got to expense our 174, and we got a credit. So we got kind of almost a double benefit there. Under TCJA, that kind of went away, and that was largely a provision again of how to pay for that. The one big beautiful bill changes that. So effective for amounts paid or incurred after December 31st of 2024, those domestic research and experimental expenditures are now deductible. So it kind of goes back to what it was before, and this is a permanent change. And so you will be able to claim that credit and expense those 174 expenditures for certain items. It does exclude kind of some land and improvements for kind of capital type assets. Taxpayers can elect, however, if they'd like, again, depending on your planning and how you want to kind of model your income kind of year over year, they can elect to capitalize and continue to capitalize and amortize the expenditures. But the other nice thing is that for taxpayers that have been capitalizing, amortizing those expenditures since 2021, they can go back and take any kind of unrecovered basis in those and expense that currently in 2025. So it's kind of an exciting provision, and it's something definitely that if you are claiming an R&D tax credit, is something that you'll want to talk to your tax provider about.
All right, great. Thank you, John. Appreciate that. Um, so real quick, before we hand it over to Ryan, we wanted to do our third polling question. If everybody could take a moment to click on this when this comes through. And then one little add-on thing on the R&D, just thinking about, mentioning that we see that a lot with our clients in the brewery space, folks with test kitchens, others are developing software, apps, or other things, technology kind of related that sometimes fits into that R&D space. So that's really why we wanted to at least mention that here today. All right. Excellent. At this point, I'll hand it over to Ryan, let him touch on some of the individual provisions. I think you're muted, Ryan.
Thank you, Kaz. You think I'd learned by now. So thanks, everybody. Again, thanks for joining us today. I'm going to take us through the end here. I know if we're looking at time, we have about 18 minutes left and 8 minutes to qualify for CPE. So plenty of time. I haven't seen any questions come through. So if anybody has any questions, drop them in the question section, and I'll be moderating and handing those out here at the end of my portion. So, here we're covering, the webinars, obviously tailored more towards business, but 90 to 95% of our client base are pass-through entities, so partnerships or S corporations, and of course, all that income and planning from the company falls out to the individuals. So that is why we're going to cover these individual items. So if you're owner operator, good to keep in mind as you do your own return. If you're a CFO and not an owner, being able to keep these things in mind for how they're going to impact your ultimate owners and some of your cash flow decisions. So first thing I'm covering here are individual provisions and permanence of TCJA items. So these didn't necessarily change. These were things that were set to expire at the end of 2025, which are now made permanent, absent any other legislative changes. So the first one is reduced income tax rates. It was slated that income tax rates, which right now are graduated from a 10% rate up to a 12% to a 37% rate, would go back up to a top rate of 39.6%. That top rate of 37% in the current rate brackets are now preserved and indexed for inflation. So as Kaz mentioned in his section, the Section 199A deduction, or the qualified business income deduction, that gives you a 20% deduction of business income. So really what that does is it brings the owner's effective rate on the operating income from the restaurant down to 29.6%. So pretty nice decrease there. Purpose again of that 199A deduction is to get the pass-through income more on par with the rate that C corporations have, which is 21.6. So the next thing here, not really needing to keep in mind on the restaurant level, but the increased standard deduction. So individuals are entitled to either the standard deduction, which is around $31,500, indexed for inflation, and then you also have the option to itemize your deductions as well. So things in your itemized deductions are charitable contributions, real estate taxes, state taxes, and mortgage interest. So generally, if you add those up and they don't exceed the standard deduction amount, you take the standard deduction. So overall, makes tax compliance simpler for most people, and create some planning opportunities, especially with charitable contributions. So, as I mentioned, as a result, the increased standard deduction is now permanent. Next, we have an enhanced or an increased child tax credit. So that was something that came about in 2018 with the tax reform bill that will stay in place and is actually enhanced. Next is higher AMT exemptions. I do not want to get into all the details and nuances with AMT or the alternative minimum tax, but this is a separate tax calculation and can't apply to individuals. So the higher exemption means that less people are subject to AMT, which is a good thing. And the last is permanence of the excess business loss limitation. So a lot of these items that we've highlighted here are really favorable provisions. The excess business loss limitation is an item that we would consider unfavorable. So what this says, if you have a loss in excess of a certain amount, right now it's a little bit over 600,000 with that amount, again, indexed to inflation. If you have a loss from your business entities that exceed that amount, you can't deduct it to offset other income, such as your wage income. And that amount that is disallowed is actually carried forward as what we would call a net operating loss. So it can be used in future years. What I was going to kind of gloss by this, and then I was thinking about it more with all the provisions that we have in place. You think about accelerated depreciation with 100% bonus. We look at the opportunity to write off your unamortized R&D costs, which, a couple restaurants I've looked at, we might have $800,000 or $1 million of R&D costs that we can deduct in 2025. The easing interest expense limitations. It is very plausible that if you have a small ownership group that doesn't have a lot of income outside of the restaurants, that you could be driving deductions on the business side, but when it hits the individual taxpayer, they might be subject to this excess business loss. So as John covered it quite a bit, some of these provisions, there's elections to, by default, you're into the favorable tax treatment, but there's elections out of that. So my comment on the excess business loss rule is just don't assume that the best option at the surface with 100% bonus or taking all your R&D in year one is the most favorable, because you could be trapped by this rule. So again, planning is paramount, especially as we get into the second half of the year here. Next, I'll move on to individual provisions, which are brand new. The first one I'll cover here, and these are probably the two that we've had the most questions on. This is the no tax on tips and the no tax on overtime. I'll jump ahead a little bit to that third bullet where we talk about employer's responsibility. This, again, a lot of questions have came from our operators, like how do we handle the no tax on tips or the no tax on overtime? Bottom line is it doesn't affect the employer really at all. The rules are that the deduction or the no tax on tips and overtime is facilitated through a deduction at the individual taxpayer level. So that is going to be all of your employees. And the reason that is you can see here, no tax on tips, that employee can deduct up to $25,000 of their tips they earn for the year. And on overtime, they can deduct up to $12,500 per taxpayer. However, both of these are subject to phase outs. So if that employee's income would exceed $150,000, if they're single, or $300,000 as a joint filer, there is potential that they would receive no benefit from this certain provision. So all the employer is required to do is report the overtime or the tip income on the W-2. So talking with most payroll providers, they will be facilitating that as they have access to that data. And the other question we're fielding quite a bit is adjusting of employees withholding. The IRS has 90 days to come out with new withholding tables as a result of this. So for now, if employees come to you, defer as much as you can. There's no need to fill out new W-4s. Hopefully within 90 days, we'll have new withholding from the IRS, which will automatically adjust the withholdings on the excluded tip or overtime income. The one other thing I was going to mention here is that this is a income tax provision only. It's not a payroll tax provision. So we know the tip credit is important to all the restaurant operators. So this has no impact on the tip credit as currently enacted. All right, next I'll go to last new individual provision. So this is increased on the state and local tax deduction. So again, this is part of your itemized deductions on the individual level. TCJA revised this to a deduction of $10,000, which used to be unlimited before the TCJA. This is a hot item that there was a lot of infighting in Congress and almost a roadblock to getting this bill passed. Where we landed at was that the state and local deduction is increased to $40,000, and once an individual's income exceeds $500,000, that deduction can be phased out. So you'll notice here that this provision does sunset in 2030, and the limit will go back to $10,000. So again, planning at the individual level is something that needs to be taken into consideration. The bill did not pass or not have any impact on the pass-through entity tax deduction and regimes which are in place by most of the income tax states as a result of the TCJA. So I would encourage you, most of the time, the pass-through entity tax or the PTET elections are going to be most beneficial to help bypass this limitation on the deduction. Next, I'll cover other miscellaneous provisions. Kind of be spitballing a couple things here. So one, this really pertains to any type of succession or exit planning. And this would be the lifetime exemption for gift and estate tax. If somebody passes, if their estate is in excess of any of these amounts, 15 million for an individual or $30 million for a couple, that remaining value in the estate can be taxed at up to a 40% rate. These were going to be cut in half under current law and are now extended to these higher amounts. So we had seen a lot of push the last couple of years to facilitate transactions before these limitations were raised. So really, at the end of the day, these allow for greater flexibility in the estate planning, and I think most of all, puts less urgency on the estate planning matters. Next, opportunity zones. This was part of the original, the TCJA bill, and got expanded in the One Big Beautiful Bill. So the way these work, I won't get into a lot of details, but if you sell an asset, which could be your restaurant operating company or real estate, and you have what we would call capital gain, you have the opportunity to defer those gains through these opportunity zones. An opportunity zone is a qualified designated census tract. Typically, they're in urban areas, economically distressed areas, or very remote areas as well. So like smaller towns maybe out like Southwest Ohio where we're at here. So that can be a mechanism if you have a big liquidity event from a sale. Investing in opportunity zones can be a way to defer the gain and also get a step up in basis on certain investments. So there's a lot to unpack there. The message is if you have a liquidity event, look at an opportunity zone and take that into consideration. Next would be qualified small business stock. This will apply to a very small subset of our client base and most restaurants, as this only applies to C corporations and not S corporations or partnerships. But essentially, this is if you have a C corporation and you sell stock, you can exclude a certain amount of gain. So the rules vary on how much you can exclude. There's a limitation in terms of dollar or the original investment amount. But what really helped here is the holding period of the stock got tranched. Used to be you had to hold it for 5 years. Now you can hold it for 3 years and get 50% gain exclusion, 4 years, 75%, and 5 years, you get 100% gain exclusion. So potential, again, if you have a liquidity event, invest in C corporation stock, or if you have, we see it more commonly in private equity deals, but if you're starting up a new restaurant and you have sophisticated investors, looking at the C corporation stock and the qualified small business stock or 1202 stock may be something to look at. Last here is Form 1099 reporting. Seems small in terms of the whole bill, but man, in the terms of compliance, this is a huge win. So for 1099 miscellaneous and 1099 NEC, which would be non-employee compensation, anytime you paid an amount in excess of $600 or more, you would have to report that on a 1099. So that is the information report that goes to the IRS and the recipient. Under the new bill, that is increased to $2,000. So say small wins, we'll take them when we can get them. Anytime we have less compliance, I would say that's better. So lastly, we'll go to sunsetting provisions. So these are two provisions which I haven't seen mentioned much, but it's a work opportunity tax credit and the empowerment zone credit. So quick overview, work opportunity tax credit is a wage-based credit for what we would call like hard to hire employees. And then the empowerment zone credit is a credit, again, based on wages. It is afforded to a company if the company is located in an empowerment zone and the employee lives and works in the empowerment zone. So the empowerment zone, again, they're more these urban core type areas. So we see that a lot here in, like over the Rhine and Cincinnati, short north up in Columbus is kind of where we can have these pockets of empowerment zones. So right now, both of these are slated to sunset at the end of 2025. So there's no expansion on these two. We were hoping they would be part of the bill. They were not addressed. We reached out to the National Restaurant Association. It's on their radar, but they're saying absent any tax extender bill, which anyone's guess if that happens, we will probably not see extensions of these two credits. So be cognizant when you're going into 2026 that these credits could be going away. All right. Last, we'll do our last CPE polling question as we wrap up here. So does your company claim WOTC or EZ?
Okay.
All right, we got more no's than yes. So say if you don't claim it and you're in an urban area, check it. You can't amend tax returns to get it. So it's a nice little, if it's been missed, it's a nice little cherry on top to reduce your tax liability.
I'd say WOTC is even more prevalent, so that's one to look at, no matter where you're located. Okay. Ryan, did you receive any questions through the chat?
I do not have any questions.
Okay. I guess one of the things that we did want to touch on, I guess just to reiterate, and I think, Ryan, you drove the point home, was on the no tax on tips and no tax on overtime. We began a ton of questions, and even talking with payroll companies that regarding the reporting, the employers really aren't going to have to do much. I think there's going to be an additional box on the employees' W-2s that's going to disclose qualified tips or qualified overtime, which the employee would then, to Ryan's point, report that on their personal income tax return, and it's an above-the-line deduction, so it's not an itemized deduction. Above-the-line deduction that they would then get the deduction calculated there, so there's really nothing the employer needs to do. So we had a ton of questions on that kind of out of the gate. So
I do have one question. So the question is, when is the 1099 reporting effective? So that would refer to the increase from $600 to $2,000. The 600 is still in effect for the 25 year. So the 2000 goes into effect for the tax year 2026. So it's not going to be until you're issuing the 1099s for 2026 in January of 2027 that threshold will become applicable.
Okay, good. Okay, about 1 minute. Anything else? No other questions? All right, good. Well, I think at this point then, if there are any other questions or somebody thinks of something afterwards, please reach out. You have all of our contact information. And we've got a couple other thought leadership articles on our website. We're posting stuff routinely there, and then other upcoming events through our newsletter, Table Talk. So please stay tuned for that. And just want to thank everybody for joining us today and appreciate your time. Thank you.